Mike, thank you. Yesterday, it was announced that federal regulators seized First Republic Bank and was sold to J.P. Morgan Chase and Company.
And with the failure of First Republic and Silicon Valley Bank earlier this year, a lot of people are wondering what's going on in the banking industry. Christian Chiu is an associate professor and chair of finance at UB, joins us now. Christian, good morning.
Good morning. Good morning to you.
And so just from the big picture standpoint, what's going on in the banking industry that's causing all this?
Well, there's two things that make these things happen to a bank. So one is the amount of deposits at the bank that are not FDIC insured, that are over $250,000. The people having these deposits, so wealthy people, they're also the most sophisticated customers. So they want the best products, that is the best rates offered by the bank. And they're also the most likely to go when the bank is not that competitive, right? So that's part number one. The more of this you have, right, the more your clients are likely to leave if the bank isn't up to their standards. The second thing is how does a bank, give money back to their depositors? Well, they're, investing in particular financial instruments, in bonds. And when people want to take their money out, they have to sell these deposits. Now, if you have a lot of customers that are very sophisticated and want good rates on their deposits, you have to invest in these bonds that give you higher returns. These are longer-term bonds. Now, longer-term bonds decline more in price where interest rates go up, and they're also more liquid. That is harder to sell, right? So you have a bank that has a lot of sophisticated clients uninsured by FDIC. These clients want the bank to be very competitive in terms of the deals that they get on their deposits. The bank invests in longer-term bonds, and then when these people want to take their money out, these longer-term bonds can be sold as easily. So this is what happened to SVB. This is what's happening to First Republic.
Well, that's interesting. So in your perspective, in your opinion, could this happen to a bank in Buffalo?
I highly doubt. I think the problems of banks like M&T is how can they absorb the deposits actually leaving the banks that are failing and then wanting to go somewhere else. And since M&T is one of the banks that are, I guess, slightly more conservative and then doing fairly well, then these depositors will seek banks like M&T. So I think the problem is how to get this money rather than how to satisfy people leaving them.
So is there anything that families can or should do in reaction to what's happening?
Well, if you happen to have more than $250,000 in a bank deposit, just diversify it actually among several deposits. I mean, you have to think think of a couple, right? So you can actually have $1 million that's FDIC insured, right? Everybody having a checking and savings account, two partners, that's $1 million. So, unless you have more than $1 million to put in cash, then you don't have to worry that much.
All right.
And then even if you do, the FDIC seems to make up for depositors.
All right, Christian Chiu at UB, thanks so much for joining us and answering these questions for us.
My pleasure.